Today we're diving into some key market updates from the first week of January 2026. We'll cover how the US economy is showing a real split between factories and services, a big settlement involving a major European bank, and why General Motors is pulling back on its electric car plans. Let's break it down step by step. First up, the US economy wrapped up 2025 with factories struggling while services picked up steam. This sets up an uneven start to the new year. Factories have been shrinking for 10 months straight. A key measure of factory activity dropped to its lowest point since late 2024, showing things are getting worse. This isn't just a small issue, it's hitting most of the factory side of the economy hard, with nearly half in a deep slowdown. Factories make up about 10% of the US economy, but their weakness affects jobs, supplies, and more. On the flip side, services like retail, healthcare, and business support bounced back stronger than expected. This sector, which drives over 2/3 of the economy, saw more new orders, hiring picking up after a dip, and even exports growing again. It shows people are still spending on everyday needs, keeping things afloat despite the factory troubles. Now, why does this split matter? Factories are dealing with higher costs for materials and trade barriers, while services benefit from steady consumer spending. This helps explain why the overall economy hasn't tanked yet. For investors, it means pressure on companies in industries like materials and shipping, where orders are down and costs are squeezing profits. But service-based businesses look more stable, with better job growth and sales. Inflation is still a worry across the board. Costs for inputs are high in both areas, which could keep prices up and make interest rate cuts less likely. Factories are cutting jobs to cope, with more talk of layoffs than hiring. Services have a brighter outlook, but they're not booming either due to those ongoing costs. For everyday people, this means spending might stay strong in some areas, but job losses in factories could hurt wages in certain regions. Policy-wise, trade barriers like tariffs are a big drag on factories, and with court rulings coming soon, uncertainty hangs in the air. The Fed might hold rates steady because of sticky inflation, though new tax cuts could give a boost. Globally, strong services help international business, but weak factories limit growth for goods exporters. Looking forward, expect the economy to keep running on two speeds. Factories might not rebound quickly due to worker shortages and trade issues, while services stay the main driver. Overall growth could slow but stay steady, depending on how long services can carry the load and what happens with trade and prices. Next, we have a major European bank, HSBC, just settled a tax investigation in France for about $312 million. This closes a probe into trading practices around dividends from 2014 to 2019. The bank didn't admit wrongdoing, but cooperated and fixed its processes. This isn't isolated, it's part of a wider European crackdowns on schemes where shares are traded quickly to claim extra tax refunds on the same dividends. It matters because it shows regulators are still going after big banks for old deals, keeping legal risks high. For investors, even strong banks like HSBC face hits to earnings from these surprises. It reminds everyone that past actions can cost real money now. Banks need to keep pouring resources into better control and transparency to avoid this. Governments benefit by recovering funds and showing they're tough on tax dodges. Across Europe, more teamwork between countries makes it harder for banks to play the system. Going forward, these risks aren't going away soon. Banks will focus on stronger rules to prevent future problems, which might trim profits a bit, but builds trust. For Europe overall, it's about tighter oversight to protect tax money and keep finances stable. Now finally, General Motors announced a $6 billion charge to scale back its electric vehicle push. Most of this is cash payouts to suppliers after canceling contracts for higher production that didn't happen. They'll book this in their year-end results with more small charges possible. This comes as EV sales slowed sharply after a federal tax credit ended in September, forcing the whole industry to rethink plans. GM had aimed to go mostly electric by 2035, but now they're tying moves more to actual buyer demand and government support. Shares dipped 2% after the news, even after a good day in the market. For investors, it's a wake-up on the risks of betting big on EVs too soon. Overbuilding capacity leads to losses. Rivals like Ford took even bigger hits, showing the whole sector is adjusting. Suppliers are hurting from these sudden changes, with paused factories and deals. Consumers won't see fewer EV options right now. GM's current models stay, but lower investment might mean slower price drops and fewer new choices ahead. Policy is key here. Without incentives, sales grew just 1.2% last year, and EVs might make up only 6% of US sales this year, down from before. Ahead, the EV shift looks slower and pickier. Car makers will match output to real demand, not just goals. Hybrids are rising, which could challenge since they are light there. Electrification is still the plan, but it'll be shaped by stable policies, affordable prices, and what buyers want. And that's the wrap on this week's market highlights. What do you think? Will services keep the US economy going, or are tariffs too big a hurdle? Drop your thoughts in the comments, like if this helped, and subscribe for more updates. And see you next time.